This is the Asia Climate Finance Podcast. The series is dedicated to the discussion and analysis of business and finance trends around the energy transition and decarbonization in Asia, the largest energy consuming region in the world. Hi, this is episode 15 of the Asia Climate Finance Podcast, recorded on the 29th of August 2022. I'm your host, Joseph Giacobelli. A quick announcement first, based on suggestions emailed to us. We've adjusted the podcast name from Asia Climate Capital to Asia Climate Finance, starting with this episode. Another suggestion is that I keep my intro shorter, so I will. Moving on to today's show, we are very, very, very lucky to have Stephanie Choi. Stephanie is the Sustainable and Impact Investment Strategist at UBS Global Wealth Management for the APAC region. In my very biased opinion, Stephanie is really a leading voice in sustainable investing in the Asia region. Stephanie and I are going to be discussing what is happening in the real world of sustainable investing in general, and in particular in the Asia-Pacific region, of course. As always, note that the views of our guests are their own and not attributable to any affiliation, past or present. Hi, Stephanie, and welcome to the Asia Climate Finance Podcast. How are you?
I'm fine and excited to be on this. Thank you so much for having me.
Great. Well, thank you for making the time. We're really, really grateful. So I always first ask our guests to briefly introduce themselves, and in particular talk about their journey to become a direct or indirect participant in Asia's path to net zero. Could you please tell us a little bit about your own journey, Stephanie?
Sure. So I've actually been in financial markets my entire career. I started off in Europe around the time of the GFC. And so my career has really been shaped by the growth of ESG as we know it today. In Europe, around the time of GFC, like in the backlash of everything we found out about then, was when ESG as we know it today really came about, and those became my closest clients and contacts in the industry. So when I moved back to Hong Kong and realized that, at the time, Hong Kong was an ESG wasteland, so to speak, I tried very hard to kind of lobby and keep up and try to advocate for increased practice of ESG in the region. And in 2018, I founded my own impact investing consulting business. So I was helping family offices in the region, trying to do due diligence and to source credible investments. And that is when I really kind of got a chance to really look at different sustainable investments across the full spectrum, from private markets, direct investment deals, all the way to, liquid public market investment solutions, which is what my career was more about. And in 2020, when UBS, this position with UBS opened, I thought it would be really exciting to join the world's largest private bank, which also happened to have the largest sustainable investing mandate back then and today, and really try and understand how I can be of value to private investors who are interested in this space.
Very, very, very interesting. Let's first start today's chat with the lay of the land, if I may. Could you give us a view from 30,000 feet on what sustainable impact investing is all about, and maybe what it's not, so that then we can kind of like put everything into context?
Yeah, so I think this is a really interesting question to tackle, even though it's, as you say, it's very high up, because recently we've seen sustainable investing get so much heat from both sides of the argument, right? So on one hand, you have politicians, ESG is being politicized as, so-called woke capitalism, and saying that as a result, financial investors or like fund managers are actually not performing their fiduciary duty. And on the other hand, you actually have really passionate and dedicated, advocates really, who are saying that ESG is no longer serving its purpose, and delivering, real world improvements and sustainability contribution. So I think part of at least from my view, part of the problem is that there's in this massive mainstreaming of sustainable investing and sustainable finance over the past, I would say, especially past 5 years, there's been oversimplification of what it is. And people just reduce it to these 3 letters like ESG. And, ESG actually doesn't mean anything. It's just an analytical framework. So what sustainable finance and sustainable investing really is supposed to do is that it's just incorporating sustainability considerations and real world impact of your investment and business decisions into your core portfolio, whatever their portfolio looks like. So it spans across all asset classes and different risk profiles. So if you're an investor who usually only invests in equities, then you will find that there are a lot of kind of ESG lens or ESG incorporated funds, or even more aggressively, you can have engagement funds, which, go a little bit further to push forward the sustainability agenda using your money. But to expect, I'm just going to be investing in, a liquid equity portfolio that represents, an optimized risk reward and sustainability footprint, and expect that solution to, be a world-saving, life-changing, game changer for the world. I don't think that is coherent either. So it's the fact that the product shelf has become very sophisticated, very diverse. And, I'm quite proud to have, I mean, we both have played a part in this, so I think it's really great that we're now a complex, beast, but that complexity is just lost to media. And that is the source of a lot of the tension and confusion right now.
And when we talk about this oversimplification, Stephanie, there's an enormous amount of noise in terms of both extremes, as you pointed out, in the US, I find a bit in Europe, but maybe not as much as the US, and it's a little bit not really discussed in Asia, or at least that's my perception. So 2 questions there: is my perception correct? And if it is correct, is it because Asia is a little bit behind the curve?
Yeah, I would say so. I would agree with with both the observation and the kind of initial cut of why it is. So awareness, just both awareness and the industry sophistication in Asia is just nowhere near that in Europe or US. If we put it in statistics, right? So according to the Global Sustainable Investing Alliance, as of 2020, so that's already very old data, but around a third of global investment assets are linked to SI, and in select markets like Canada and parts of Europe, that penetration rate is like 60-70%. In Asia, even the most aggressive estimates have us at like mid to high single-digit penetration. So this means that there's both like a demand and supply implication here. The first is that the people who are demanding this product are not really asking the questions that would prompt those sensitive issues, right? And from a supply side, because the funds and the, I guess the whole approach is just less well practiced, it's less commonplace. It doesn't have the same effect on funding markets the way it has in Europe. So we don't have a greenium, for example, amongst Asian green bonds yet. But whereas the a greenium, which is, a price premium for a green bond versus a non-green one for the same issuer, that actually has had some evidence of coming in play in both US and Europe. So if they're not, if it's not really kind of quote unquote making a difference, actually affecting the day-to-day running of markets, I think people have been much more blasé about it. And in Asia, it's been really still seen as a feel-good factor thing. Also, erroneously. But I do think that right now we're at a pretty interesting juncture because we have the chance to really learn from all these lessons that we're seeing in the US and Europe and really try and leapfrog. And equally, because the penetration rates are relatively low, so there's still quite a lot of win-win opportunities out there that could be both financially and, from a sustainability impact standpoint, lucrative.
You've been interviewed by quite a few media outlets and industry journals, etc. And I listened to a few of those interviews, and in one of them last November, you mentioned something along the lines of, some private banks having the sustainable investment products actually preferred by their clients, especially when it comes to private wealth management. Could you kind of a little bit unpack that or explain that?
Right. So I think in the industry in general, we have seen a rise of sustainable investment demand, right? As I mentioned earlier, this. So if we look back on those the statistics I shared in our previous in the previous question, institutional investors penetration rate globally is like 1 in 3. In private markets, it lags. So there are no great statistics, but it's known to be like much lower because the mandate is a little bit different. But we have seen the rise of kind of boutique banks that specialize only in sustainable investing in the market as well. So there's obviously demand. At UBS, what we do is we actually take a more leadership role. So on top of catering to clients who are interested in sustainable investing, we actually go out of our way and we made sustainable investing our preferred investment solution as of 2020. What this means is that when a client, like for any UBS client, sustainable investments would be the first lot, like the priority suite of product solutions offered to any client at any given point. And since we announced this in 2020, and we were the first private bank to announce this globally, but what we have found is that like clients are actually not declining. They're not really saying no. So obviously, on one hand, our growth in sustainable investment assets have really snowballed a lot since then over the past 2 years. But just going back to why we would make that announcement in the first place is that we are really convinced that sustainable investments matter to all investors. So we're not saying that every client, all assets for all clients should be sustainable, but SI assets have a role to play in any portfolio because they present more attractive longer-term risk reward.
Talking about sustainable investment products, how do you deal with the whole kind of greenwashing concept, which again is something which has hit the headlines globally? My 2 pennies worth is that, again, it's something which is it's part of an evolution. And in my experience, actually, some companies that are accused of greenwashing, they didn't necessarily do it on purpose. It's just they didn't they were not very eloquent in terms of the presentation of their ideas and strategies. But that's just my two pennies worth. So how do you kind of address this whole greenwashing issue?
Right. So I think it all goes back to the spectrum argument, right? The fact that sustainable investing is a full spectrum suite of different investment solutions. And there's a tendency to oversimplify it. And I think what happens in greenwashing really is when you have a misrepresentation of risk and return, right? If we think of, impact and sustainable returns as, for like from a quantitative standpoint, like a financial analyst would, right? Then it is a curve, right? And the greenwashing happens when you're misrepresenting where your product lies on this curve. So, for example, if you are, as I mentioned earlier, you're pitching an equities portfolio. This is, risk adjusted, large caps, all country world. It's as close to a vanilla product as possible, but just with ESG integrated. And you're claiming that this product is going to, save our children and the world. I think that is obviously greenwashing, right? So it's really recognizing what does this product do, right? So I'm not saying that equities products do not do anything. In fact, the fact that, liquid product solutions have reached the scale that they have today is a reason why we have, it's so much in discussion. There's so much media scrutiny. Regulators have already tightened disclosure rules. And all of that is a positive, virtuous feedback loop, right? Because the more of these infrastructure improvements happen, the better and the smoother it would be to make these sustainable investments. So it definitely has a positive signaling effect. At scale, it changes the behavior of governments and regulators in a way that individual investors really cannot make. So I think the glass half full way of looking at this is that, okay, at no incremental risk that I'm taking, I am contributing to something larger. Yes. So I think, it's recognizing that the whole suite of sustainable investments across all these different asset classes and different risk profiles, they have a role to play in our fight to deliver climate action, which is like the focus of this podcast, but also in hopefully making business as usual a bit more responsible and sustainable. I think recognizing that, then you realize that, greenwashing is not about the product; it's about the marketing.
Yeah, that's what I was alluding to. So a lot of companies are not that eloquent when they explain their strategies. How do you layer on top of that the fact that so we talked about sustainable investment products? Is it me, or do I feel there's a little bit less controversy when it comes to green bonds or sustainability-linked bonds in terms of the greenwashing kind of side of things? Is it? And if that's correct, well, first let me ask you: do you have that feeling as well, that there's less controversies around that?
I wouldn't look. I think very different purpose, right? So with, let's say, a green bond, they're because of the use of proceeds, earmarking, not ring fencing, right? So I think that in itself is already like a small caveat. But so there's a use of proceeds earmarking, which of course delivers a great deal of transparency and accountability. And as such, the pushback is not really in the instrument itself, but there's huge controversy around, for example, the taxonomy. Right. So what qualifies as a green project that would then qualify for green bond issuance? And the second area where it's controversial, and that's the reason why sustainability linked bonds came about, is that although you get a lot of transparency for this single bond, unless this bond is, the entirety of the company's financing construct, you don't really have a way of influencing longer term behavior for the company, right? So you're contributing towards a project, but you're not actually challenging the modus operandi at the company itself. So the sustainability linked bond is supposed to do that by, imposing, or highlighting company level KPIs to be delivered as part of the terms of the bond. So I think that I would say the cut of the impact intervention is very different already between these two instruments. But then if you think about engagement, equity engagement, for example, you're actually directly leveraging on share ownership to force and catalyze behavioral change at the board level. There are some funds that are actually insisting on taking board seats as part of their ESG engagement solutions. So I would say that I wouldn't constrain the kind of authenticity of impact to labeled bonds or like specialized product instruments. I would say that it really has to do with the strategy and how it's implemented. And that's why there's this, SI is always going to be a bit difficult because there's just so much that is personal choice, right? Because you can't just outsource this decision completely to a third party and expect that menu to look exactly the way you want it. And that's why, that oversimplification and that urge to oversimplify in order to market it is both kind of understandable, but also slightly problematic in the face of all the scrutiny that we're getting right now.
Got it. Very interesting points. When it comes to, we discussed that. I guess your conclusion is that sustainable investing or SA products is not is just one of many tools in the kit, so to speak. When it comes to Asia specifically, we also mentioned that Asia is a little bit behind when it comes to SI compared to Europe or the US, which also makes it, it's evolving, so there's lots of opportunities. Where do you think that there would be the most the clear and present opportunities in the Asia Pacific region from when it comes to the SI business?
Right. I still think it is engagement because, and I keep coming back to this because engagement is not only a tool to catalyze sustainability improvement, it's also a chance for investors to really understand kind of the operational and strategic trends of the underlying company. So, I mean, as an analyst yourself, you know that, management meetings and engagement with management, even outside of a sustainability or ESG context, is extremely important to fundamental investors anyway. But especially on the area of ESG engagement, I think the interesting development is that corporates are actually seeking investors' advice. So rather than, in a traditional environment where all the investment analysts are banging on like the doors of Samsung or something and trying to beg for them to give us information. This is really different, right? So across Asia, we're actually seeing a lot of corporates, and even at UBS, our business owning clients, they're actually seeking partnership and guidance from investors and financial institutions such as UBS to talk about okay, I have all these people asking for ESG information. What is it that matters to investors, and where are the opportunities that I should focus on? And to work on something like that with a corporate is very rare in Asia. Like the corporate culture is not had not traditionally been like this. But it also gives a lot of impetus for actual change on the ground. And if you look at probably the most kind of hallmark academic study in this area was published in 2015, Dimson et al. And they basically showed that in Europe, around the time when sustainable investing is really growing in Europe, they tracked the engagement efforts and investment returns of a fund. And if like for successful engagements, they've actually correlated with 18% of abnormal returns at the stock level within the 18 months following successful engagement. So this is something that is very clearly dictating that there are win-win opportunities here, because there's a time when policies have to change, company policies have to change, strategies have to be developed, and investors who are lucky enough or know enough at this point to actually go in and contribute could also learn from it and position accordingly in the market in order to generate supernormal returns. And that's why I say that, it's actually exciting to look at Asian markets relative to, let's say, Europe, because I feel like it's still very blue oceans out here. There's still a lot of low-hanging fruits that can be, snatched.
Apart from China, which I want to talk about separately because it's biggest, it's basically the biggest energy transition story in the world. In terms of other countries around the region, which ones do you think are making some kind of some advances or advancing more than others?
So super interesting question, because I think it's very interesting to observe that. So, for example, in Hong Kong and Singapore, obviously, given leading financial hub status, like international relevance and everything. So, if you look at the policymaker stance and the amount of money that's thrown in, then Hong Kong and Singapore by far leads, right? But from a corporate context, like Hong Kong businesses and Singaporean businesses do not actually score that well from an ESG perspective. And, and I'm using the ESG ratings quite with a pinch of salt here, right? We're just using that as an indicator.
Yes.
But if you look at where the performance is actually very strong are places like Thailand. So I think one reason is that in Thailand, the corporate market cap concentration is actually quite high. So, you have conglomerates or leading companies that actually own a large part of or represent a large part of the economy. And so by changing the behavior or thinking of a select few, you can actually have quite a multiplier impact across the market and economy. I would say another country where it's quite interesting is Indonesia. Similarly, you have some sort of this, but also because they have quite a lot of natural capital. So we've actually seen a lot of demand from our clients, in Indonesia, coming up for okay, I have this plantation and I want to make sure that it's responsibly managed. What are the resources we can use to ensure that we're good stewards? And so it is really interesting and actually quite encouraging to see these trends and demands come up, because it really shows that sustainable finance is doing something. I don't know how much, but we're definitely contributing to some extent.
No, those are two great examples, Thailand and Indonesia. Moving on to kind of the massive elephant in the room, China. I think you and I have spoken about China before, and we've got quite similar views. But could you just explain to listeners exactly where we're at in China today in terms of meeting ESG goals, what's going on regulation-wise, etc.?
Sure. You're the expert. But I think from my perspective, bullseye perspective, bottom line is that China today, despite the fact that they are still the world's largest polluter, they are also one of the forerunners in terms of actually meeting climate pledges and goals, right? So if you look at there's an excellent kind of project by project recap by Carbon Brief of China's clean energy rollout in the coming years. They're expected to almost double their renewable capacity between 2022 and 2025. So within 3 years. This is extremely aggressive, extremely ambitious, and because it's China, it's actually deliverable. So yeah, I think there's a lot of pushback about kind of China's policies, like policy pledges, being the 2030, 2060 twin goals of peak emission and net zero, respectively. There's a lot of pushback saying that it's not aggressive enough, but it can actually be delivered, right? So, so I think from a top-down perspective, the direction is very clear. The money is clear. The source of the money, how it's going to be spent. It's also relatively clear. The tension that I am slightly concerned right now is the local versus state level commitment to this, right? Because I think obviously when the economy is growing like 6-7%, it's easier to just execute. But with the economic challenges and even with the energy security risks that we have seen over the past year, not just in China but globally, we have seen some divergence between kind of local and state policy commitments. We're supposed to be in this big strategic shift where we're building out these massive clean energy farms in the West and basically piping that power back to fuel the East. But, if you're Zhejiang province and you're wondering if you have enough power to fuel up your city in this coming winter, it's really hard to say no to coal. And so these are the kind of more on the ground levels of tension that we've noticed of late. And I think that is probably the only potential spanner in the works. But overall, I think that China is very good at delivering on what they have pledged. And there's no indication right now to think that, there isn't. And to some extent, they've kind of just embraced that energy security and economic growth and net zero dilemma up front, whereas and Europe is actually kind of seeing all of that unwind right now.
I think the interesting side of it is it's such a humongous country in terms of whether it's number of companies, amount of people, amount of land, etc. But if you look at it at the micro level, there's quite a few interesting things that can be found. And in the most recent analyst calls that the energy companies had, it's amazing how many of them, actually all of them, have very, very clearly and very eloquently talked about their commitment to a non-fossil fuel, energy supply, and with very, very, very clear plans. And if you compare what some of these companies said at the end of the Q2 results, which was again this month in August, compared to what they were talking about at the end of the Q1 results, which was back in April, they're more aggressive. They've actually upped the numbers quite a bit. So I think if we look at it from the micro perspective, you get a very different picture. And that said, there are some very, very distinct local challenges in some provinces or some specific jurisdictions. Sorry, that was a little bit of a soliloquy on on my part.
No. No, I think you're right. I think what I would say is that and to some extent, this is not just in China, but also in the world, right? Which is that we are seeing a massive coal revival because of the global energy crisis.
Mm.
I think it's to do with, right. So obviously there has been a problem because fossil fuels have been structurally underinvested for the past 7, 8 years or so. So fossil fuel investments peaked in 2014, but demand obviously did not peak in 2014. So you have this mismatch, and that's a reality, right? So now renewables are becoming more competitive in this, like on a relative basis, because energy prices have soared. But it still takes time. It's not like coal or oil. You can't just plug it in and burn it, right? It takes time to roll out. So in the near term, we're definitely going to see coal revival. We're definitely going to see maybe a lot of marginal capacity in the fossil fuel space that we probably wanted to have gotten rid of, that would come back on board, right? I think the question is like, what is this going to do? Like, what is going to happen to them on a 5 to 10 year time frame, right? Because as a utilities analyst yourself, you know that coal plants don't get built for a year. They, so how are countries gonna come up with a way to to start winding down these capacity in the next decade or so? And I think that is probably the bigger question that at the moment we have zero visibility on, right? Because within 10 years or maybe 10, 15 years, countries are going to have to subsidize the coal sector instead of the renewable sector, right? They're going to have to pay them not to burn coal. And I don't think that is something that people have begun to realize yet.
No, yeah, totally agree. But I mean, definitely you see companies really coming out, and I'm talking about whether it's oil companies like Sinopec or power companies like Huaneng, coming up with very, very aggressive non-fossil fuel generation plans over the next few years, like you highlighted earlier. And I think that particular point is perhaps a little bit missed in the discourse of China polluting the world and all the rest, which sometimes some of the views need to be corrected, but that's a different discussion for a different day. I was wondering, when it comes to fund flows in general, could you give us just a general broad idea of what is happening in Asia, if you've got any particular views on that? I mean, have you seen, for example, an increase in fund flows because there's an increase in interest? Have you seen witnessed that at all?
Sure. So I think the most objective data I can probably cite would be from Morningstar reports. So if you look at Asian fund flows based on the sustainable fund classification done by Morningstar, then what you've actually seen is that this year has still been a pretty strong year for Asia. First quarter was actually like a record because of multiple fund launches. I would say that in Asia, because the product market, like the product landscape, is not it's quite patchy and it's quite nascent, which means that the fund flow cycle really closely maps product launches by big fund houses. At the moment, if you look at the landscape of investment funds available in Asia, there are very few that are genuinely, startup funds. The majority of SI labeled funds are relabeled. So, they introduce ESG integration, but otherwise the strategy is relatively unchanged. They have the same fund manager, and that is lower risk, right? Because at the very least, your return profile or your financial track record is, it can be carried. Right now, if you look at, freshly like start up from scratch sustainable investing funds. There are very few in the market, and even fewer that have actually hit the 3-year track record mark, which is when typically like a wholesale distributor, like a private bank, would be comfortable bringing them on. So I think that has been an inhibitor. I wouldn't say so. It's partly supply driven. It's not just a factor of demand. Yeah, so I would say it's very lumpy. Within UBS itself, we're still positive this year, which is in line with global industry trends. So yeah, I mean, if you look at global fund industry metrics, AUM has shrunk. Total AUM has shrunk, and fund flows have dipped to negative. But in SI, fund flows have slowed, but are still negative. Are still positive overall. Sorry.
Very, very interesting. And are we seeing any new funds, SI funds coming out of China at all? Because I don't remember seeing anything, but I'm not sure.
Yeah, well, we've actually a lot of the focus has been on ETFs. If you look at, I don't have like the latest data this year either, but then if you look at 2021 data, they've been very dominated by ETFs. And this part and parcel with the fact that ESG data is kind of really just picking up in China, right?
Yes.
You have the Ping An data set that is a very valuable data set that has recently, really been made available. And you have the framework, the ESG data disclosure voluntary framework come out in, I think it was June. So all of this kind of goes towards fleshing out this data. But based on kind of like the surveys that we have shown and kind of like fund industry surveys and analytics, I think there's still a big gap in talent sourcing for actively managed SI funds. And that is the biggest bottleneck. So like most of the fund players onshore who are actively managing, SI funds, they would be kind of subsidiaries of global offshoots.
Got it. Just to look now at the long term. I'm originally Roman, and I love the expression that Rome was not built in one day. So if we look at the long term, could you please theorize where is sustainable investing heading in the Asia Pacific region, specifically 2 or 3 decades from now? And at the same time, could you kind of perhaps explain some of the hurdles to your prediction? Tough question.
I think, I probably won't say theorize. I would say just hope, because I think that's all I can do right now is just hope for the blue sky. I think that eventually SI penetration would have to reach at least global comparable levels. I think there's a natural peak to this because even especially in areas like private investments, you can see that the way Asian investors invest is very different from in Europe or in the US, right? So for example, there's much more kind of execution-based trading rather than kind of outsourced mandates and delegation. And I think that's part and parcel with like just regional culture, as well as closer business ties, operational business ties of the same business owning family, and they therefore want to have more autonomy over their own assets, right? So all of these would play a part. So I do think that penetration in Asia would be capped relative to Europe. I also think that because of the nature of like just the level of unevenness between different Asian countries in an ESG level is actually to some extent like, it's even worse than from an economic level, right? So it would be very difficult to create robust products that are one size fits all. So as a result, I think for the foreseeable future, the dominant product, like the most of the products that we would see would be Greater China products, and at best maybe like ASEAN 6, like, but that it would be niche, right? And as a result of that, I think going back to, if you believe that the long-term virtuous cycle is that the more assets get poured in, the more the infrastructure fleshes out, and the more mature a market becomes, you would really see a dramatic polarization of the SI investment landscape within Asia. With the exception of kind of the second big area of what I hope to see would be carbon asset transfers. And this is really not talked about in Asia. I think Asian corporates, like the awareness of carbon credits is behind, even more so. But the big contention for COP27 like this year is really in trying to establish some sort of carbon asset transfer process, so that in layman terms, we're basically trying to force rich countries to pay the poor in order to build their climate resilience and to preserve natural capital. Now, it's going to take a political miracle to get there. I don't think, even in the best of times, it'll be really hard to ask politicians for this, but especially, in the current environment when economic growth is not as rosy all of a sudden. But this is really important because, like, even if we just look at, what Congo has done, right? So at COP26 last year, they already, the UN body basically managed to get a multilateral agreement to give them $500 million to preserve their rainforest. But still, it's not enough. And so in July, they put up, 30 blocks of oil and gas assets for auction. And it's expected to destroy some of the most valuable parts of its rainforest and release billions of tons of carbon. So this is something that is a classic kind of tragedy of the commons issue, where our collective safety or climate resilience globally is reliant on people who are not incentivized to protect it. And so if we can get some sort of breakthrough on this front, I think that would be the biggest game changer for emerging and frontier Asia, which would otherwise be, like, I suspect, kind of lagged behind. Especially in the context of, how far ahead SI is looking for China.
You mentioned earlier, I believe that you see Greater China as being a little bit of a leader on a 10, 20, 30 year view. If that is the case, do you think there's a good chance that that kind of trend would also overflow and influence other areas like ASEAN? Is that one potential prediction, or is it just too hard?
I think no. I think it's possible. I think it's to do with it's probably just a matter of scale. So what you have seen is that, if you just look at the most traditional supply chain, where, Nike and Adidas are forcing their Chinese vendors to clean up their supply chain and production lines, etc., across ENS and to some extent G. And that is kind of being filtered down to the ASEAN economies because, productions are now shifting to South and Southeast Asia. So it's definitely going to happen. I would say that the progress might be a bit slow because just in general, like on sustainability issues, we don't really have a robust auditing and policing system yet. So it really relies on infrastructure. And, then it goes back to, my worry that if the infrastructure build out and the momentum is really confined to like the Greater China region, then the positive spillover effects are not going to be as strong as they would otherwise be for the ASEAN economies, for example.
Absolutely, makes a lot of sense. Well, look, this was really, really great, Stephanie, and we are very, very sadly, at least for me, at the end of this episode. But could I please ask you for your final thoughts or final comments, final takeaways for our listeners?
So I think in this year, with the macro volatility, I think it's really tempting for a lot of investors to just say that they don't have any headspace for something like SI. But it's, I think if you look at the data clear that institutional investors, like, professional investors disagree. And I also don't believe that sustainable investing is a fair weather strategy. It's one for the long haul. And if we can, collectively stop thinking of it just as, a risk alignment or like tick the box or feel good trade, then this could be, a very, very exciting time to enter the market or to introduce more elements of sustainable investments into your portfolio. So, for example, like with energy prices going up so high, then the economics of a renewable transition has just become that much more attractive. So whether it's from a thematic perspective or from, ESG integration or impact investments, in private markets, I think there are still a lot of opportunities to be had. So if investors can just stick with us a little bit and, keep the faith on SI and I guess investment markets in general, we hope that it would actually be fruitful.
Great. Fantastic. Well, Stephanie, once again, thank you so much for being so generous with your time, and thank you for all of your insights today.
No, thank you for having me. And thanks for the chat.
I hope you did enjoy this episode of the Asia Climate Finance podcast. I would really appreciate any feedback, topic ideas, etc. My contact is in the show notes. Thank you.